What if I told you that the US government has a secret plan to revalue gold at $15,000 an ounce, and it will wipe out the current year's deficit and reduce the US government debt, and it won't cost you a single penny? It sounds impossible, right? But this plan is not only possible, it's been done before, and I think it's in the making as I make this video. And the key to all this is gold. A revaluation of gold to $15,000 would generate $3.9 trillion of windfall for the Treasury. It would wipe out the entire budget deficit for 2025 or 2026 when they do it, and it would allow the government to pay down a huge chunk of the national debt.
Amid rising sovereign debt burdens and mounting structural deficits, a growing number of analysts are re-evaluating the role of gold in sovereign finance. One idea gaining momentum among monetary historians and financial insiders is the formal revaluation of official gold reserves. This adjustment could fundamentally alter the balance sheets of debt-ridden governments without new taxation or spending cuts. While projections vary, ranging from $5,000 to $20,000 per ounce, the implications for monetary policy, debt management, and asset repricing are profound. Clive Thompson, a market analyst with over 50 years of experience, believes such a revaluation is not only plausible, but likely underway behind the scenes. Drawing parallels with the 1934 Gold Reserve Act, which allowed the U.S. government to generate a massive windfall by unilaterally increasing the statutory price of gold, Thompson outlines how a similar maneuver today could yield trillions in instant balance sheet relief, resetting fiscal expectations without triggering a formal default. A gold revaluation of this magnitude would represent a seismic shift in global capital markets. Institutional investors and central banks holding physical metal would see their positions surge in nominal value, while gold mining equities could undergo a historic repricing. For private investors, the revaluation would mark a validation of gold's enduring role as the ultimate monetary collateral, independent of counterparty risk or political discretion. In today's video, we'll unpack Clive Thompson's full breakdown of how this revaluation could be executed, why whispers about it are intensifying in policy circles, and most importantly, how you can position yourself before the window of opportunity slams shut. Stay tuned, hit the like button, and subscribe if you want to stay ahead of the curve as monetary history prepares to repeat itself, only this time with trillions on the line.
We're talking about a potential revaluation of the US government's gold holdings from the statutory price of $42.22 to $15,000 an ounce. Today, I'm going to break down how this could happen, who gets rich, why the whispers about this plan are getting louder in the highest circles of power, and how you can know when it's about to happen and prepare yourself. Let's start with a simple fact. The United States government owns a lot of gold. It's about 261.5 million ounces, to be exact. On the official books of the government, this gold is valued at just $42.22 an ounce. That's the statutory price of gold set in 1972. The gold thus has a book value of only 11 billion US dollars. But at today's market price of about $3,300, that same gold is actually worth over $862 billion. And if gold were to be revalued to $15,000 an ounce, that gold would be worth over nearly $4 trillion. But let's go back in history a little bit. Where did this gold come from in the first place? Currently, it's held by the US Treasury, which is a branch of the US government. Back in 1934, in the middle of the Great Depression, President Franklin D. Roosevelt signed the Gold Reserve Act. This law forced the Federal Reserve, who held the gold, to hand over all of its physical gold to the US Treasury. And in return, the Federal Reserve got a piece of paper, an IOU called a gold certificate. If you look at the Fed's balance sheet today, it's the very first asset listed on the balance sheet. It's called Gold Certificate Account, and it's valued at that same $11 billion. But it's just an accounting receipt. It's not a claim to get their gold back, ever. The Federal Reserve cannot and may not convert that certificate into gold, and it has no right to ask for redemption of the certificate. So the only way it can be redeemed is if the Treasury so decides, and if they redeem it, they'll redeem it at the statutory price of gold, i.e. at $42.22 an ounce, which is $11 billion. So that gold certificate is on the books as $11 billion. It's only worth $11 billion, and it never will be worth any more, and it can't even be cashed in, at least not at the holder's behest. So we go back to 1934. All that gold was transferred from the Federal Reserve to the Treasury as a result of the Gold Reserve Act. Roosevelt wasn't done on that day. The next day, he devalued the US dollar by over 40%. He did this by changing the official price of gold from $20.67 an ounce to $35 an ounce. Or more precisely, as it was worded in his proclamation, he reduced the gold weight of the dollar from 25.8 grains of gold, 9/10 fine, to 15.715 grains of gold, 9/10 fine. Obviously, we know it today as an increase in the price of gold from $20 to $35. Now, this move, this genius move at the time, created a $2.8 billion paper profit out of thin air. And Roosevelt made absolutely sure that that profit went straight to the Treasury, not to the Fed. He said, and I quote, "We believe that all profits should revert to the Treasury of the United States for the benefit of the country as a whole." And with that, the Fed was left with a bit of paper and nothing more. Obviously, their real gold was now gone. The move shocked bankers in London, Paris, and Zurich. The mighty US dollar that they held had suddenly lost 41% of its value overnight. Foreign bankers saw it as an aggressive, unfair trade tactic. It was a clear signal that the old rules of money no longer applied. So, why am I talking about something which happened 90 years ago? Because today, the USA is facing a similar crisis. The national debt is spiraling out of control. The interest payments alone are becoming one of the biggest expenses of the entire federal budget. The government has to refinance about $9 trillion of its debt over the next 4 years. That's roughly 1/3 of its debt. This debt was issued when interest rates were low, about 1.5% to 2%. Today, interest rates or yields on bonds are closer to 5%. That refinancing cost, which is coming over the next few years, is going to cause the government's interest costs to explode. Something has to be done, and that's where the 1934 playbook comes into focus. The idea, gaining traction, is to repeat Roosevelt's move, but on a much grander scale.
What followed was a deliberate devaluation of the US dollar. Roosevelt increased the official price of gold to $35 an ounce, a 69% revaluation. This instantly created a $2.8 billion accounting gain for the Treasury without any change in economic output or taxation. That gain was monetized and redirected to government accounts, enabling fiscal stimulus and public spending without new debt issuance. Foreign creditors were caught off guard, and the move marked a pivotal shift in global monetary policy. The most critical aspect, it was executed unilaterally and without warning. Today, the structural dynamics are even more favorable for a similar maneuver. The U.S. Treasury still holds approximately 261 million ounces of gold, officially booked at just $42.22 per ounce. At current market levels, that reserve is worth over $860 billion. Yet on the federal balance sheet, it remains listed at a mere $11 billion. This accounting distortion is not an accident. It is latent fiscal potential waiting to be unlocked. Clive Thompson argues that by simply repeating the 1934 playbook, this time by revaluing gold to a higher statutory level, the Treasury could create trillions in balance sheet liquidity. The mechanism is legally straightforward. Reacquire the Fed's gold certificates at face value, adjust the statutory gold price, and resell the same gold to the Federal Reserve at the new valuation. The result: newly created cash credited to the Treasury without issuing public debt, while the gold remains under Treasury control. This is not theoretical. It is an established precedent with a clear legal infrastructure. The tools required to execute it, presidential proclamation, Treasury authority over official gold reserves, and the existing structure of gold certificates, are already in place. And in the context of exploding interest obligations and a deteriorating debt profile, the incentive to deploy this mechanism has never been stronger. Let's get back to Clive Thompson's video.
A revaluation of gold to $15,000 would generate $3.9 trillion of windfall for the Treasury. It would wipe out the entire budget deficit for 2025 or 2026 when they do it, and it would allow the government to pay down a huge chunk of the national debt. So how would this work technically? Because it's a kind of monetary sleight of hand, but it can be done in 4 simple steps, which I'm going to outline. And I'm not asking for any Nobel Prize for explaining this. First, the Treasury would buy back the gold certificates held by the Fed, paying the value, $11 billion. Secondly, the President would issue an order raising the official statutory price of gold to $15,000 an ounce. Thirdly, the Treasury would now sell all of its gold to the Federal Reserve at the new price, the new statutory price, receiving in exchange $3.9 trillion of newly created digital cash. And finally, the government would repeat the 1934 trick, which is to pass a new law forcing the Federal Reserve to hand over that gold back to the Treasury in exchange for, you've guessed it, another gold certificate. The end result: Treasury's got its gold back, plus it's got $3.9 trillion in cash created out of thin air. $3.9 trillion in cash created out of thin air by the Fed. And since the gold certificates aren't counted as government debt, the national debt could be drastically reduced, and, of course, in the current year, there would be a huge profit made by the Treasury, resulting in a budget surplus instead of the huge deficit that everyone's expecting. So who wins in this scenario and who loses? Well, the biggest winner, by far, is the US government. But the other beneficiaries would be anyone who owns gold, or anything related to gold, such as gold mining stocks. Central banks in countries like Russia and China would see their assets soar. Individuals who own gold coins or bars would see their wealth multiply. And of course, gold mining companies would become incredibly profitable overnight. Now, probably you're thinking this just benefits the rich. And at first, you're absolutely right. I mean, let's consider Scott Bessent. He's the Secretary to the Treasury, one of the most important positions in the country. He has a say in what will happen. But before he was Secretary of the Treasury, he was the founder of a major hedge fund called Key Square Group, which had exposure to gold mining stocks. And before that, He was part of George Soros's team, the man who broke the Bank of England by betting against the pound. So taking big bets is something that he will know all about. Now, whilst he's probably divested himself of these private interests, probably as a requirement of becoming, taking office as Secretary of the Treasury, his public statements are what are most interesting. And this is where I get the information to say that remonetization of gold, probably at $15,000, is under consideration as I speak. So what Scott Bessent has said, he has talked about the need to monetize, and I'm using words he used, monetize the asset side of the US balance sheet. Now, if you're a financial insider, you know that's a clear code phrase for revaluing gold. Whilst he didn't use the exact phrase revalue gold in the context of the US balance sheet, the single most undervalued and readily monetizable asset on the balance sheet is the nation's gold reserve. It's crystal clear when he says monetize the Treasury's assets. He must be talking about gold. There is nothing else that can be monetized. Now, I don't want to over-dramatize here. You can listen to me, and then you can go and do a Google search or ask ChatGPT to check what I'm saying is true. But just remember, those are the exact words of the most important person in America when it comes to the soundness of the United States finances. And the way to monetize gold, or rather, let's say the way to monetize the Treasury's gold, is simply to repeat the 1934 sleight of hand. It was done before, so why not just repeat the trick? So how likely is this to happen in the near future? Well, any plan this big would have to be kept top secret until the very last second, so you won't see it announced in the news beforehand. But there will be signs. The only advance warning you might get is a rapidly rising gold price and a falling dollar without any obvious explanation. That could be a signal that insiders who knows what's coming are making their moves.
Clive Thompson's $15,000 gold projection is not a random figure. It is a calculated estimation grounded in monetary mechanics and fiscal necessity. A revaluation to that level would yield a windfall of approximately $3.9 trillion for the U.S. Treasury, effectively eliminating the projected budget deficit for a fiscal year and allowing for significant deleveraging of federal debt without triggering a political crisis or default. But what sets this scenario apart is not just the mathematics, it's the convergence of political signaling and institutional behavior that now surround it. At the center of this alignment is Scott Bessent, the current U.S. Treasury Undersecretary and a former hedge fund executive with a history of high-conviction positions in the gold and mining space. His public remarks have largely gone unnoticed in mainstream discourse, yet they contain unmistakable monetary implications. Bessent has repeatedly emphasized the need to monetize the asset side of the federal balance sheet. For those familiar with sovereign finance, that phrase is not vague. It is a direct reference to the latent value of the Treasury's gold reserves. No other asset class on the balance sheet carries such embedded, underutilized monetary potential. Bessent's choice of words mirrors the coded language used ahead of major financial shifts. Just as Roosevelt framed the 1934 gold revaluation as a patriotic adjustment to stabilize the economy, modern policymakers are laying rhetorical groundwork for extraordinary measures. Clive Thompson highlights that gold is the only asset on the Treasury's books that can be monetized without issuing new liabilities. The legal architecture is already in place, and the market distortions required to justify such a move, rising yields, debt rollover pressures, dollar weakness, are already manifesting. Simultaneously, capital markets are signaling a rotation that mirrors this thesis. Major institutional investors have begun to liquidate long-duration equity positions, particularly in technology and cyclical sectors, while reallocating capital toward precious metals, mining equities, and hard asset alternatives. Gold ETFs have seen renewed inflows. Central banks, especially in the BRICS bloc, continue record-setting purchases, and mining equities are experiencing abnormal accumulation even amid broader market volatility. These are not retail flows. This is insider capital, strategic, patient, and deeply informed, moving in anticipation of a structural repricing event. The correlation between rising gold prices and weakening treasury auctions further supports the idea that market participants with knowledge of the system's vulnerabilities are hedging against a coming realignment. If history is any guide, the official announcement, should it occur, will arrive with no warning. But the footprints are already visible. The revaluation of gold is not a fringe theory. It is a proven instrument of fiscal recalibration. In 1934, it was deployed to stabilize a domestic depression. In the modern era, it may be used to navigate a sovereign debt spiral. Clive Thompson's analysis is not a forecast. It is a framework. And within that framework lies a rare moment of asymmetry for investors who understand what gold truly represents. Unencumbered, stateless collateral that central banks will always return to when the mathematics of fiat begin to fail. If you already own gold or hold exposure through miners or related assets, hold your position with conviction. If you don't, the time to act is not when headlines confirm the move, but now, while signals are still visible only to those paying close attention. This kind of repricing event won't be gradual. It will be abrupt, permanent, and largely inaccessible to the unprepared. Smash the like button and subscribe now to stay ahead of the curve. Share this video with anyone you care to see positioned on the right side of history, and remember, the next phase of monetary policy won't be televised, it will be executed. Thanks for watching.